Good morning. It's the day after May's MPC meeting, and so it's something different from the norm. That's right. After about 2.5 years, the Monetary Policy Committee of the Central Bank of Nigeria raised the monetary policy rate by 150 basis points. That means that Nigeria's MPR, that's the monetary policy rate, has gone from 11.5% to 13%. What does that mean to you? How will it affect your business and your daily living? Well, you're welcome to Business Morning. This is where you will find out, and we'll start that by having a conversation with the Chief Executive Officer of Center for Promotion of Private Enterprises, Dr. Muda Yusuf. He joins us virtually now to share his thoughts on some of the things we should expect following this hike in the MPR. Good morning, Dr. Yusuf. Thank you so much for joining us this morning.
Good morning, Yini. My pleasure.
Great. So this did not come as a surprise for people like you. We've had this conversation over and over, and it's expected that the central bank should do something. So now that we have this rate hike, some people say it's more aggressive than economists thought. But what should we expect? Do we expect this to automatically deal with the issue of inflation?
Certainly not. The issues impacting on inflation are much more fundamental than issues of monetary policy or MPR. But let me say that this policy move has both costs and benefits. The benefits has to do a lot more with the impact on the fact that we have, for many financial sector investments, negative real interest rates. So this may help to reverse that trend a little. It will also have some positive impact on returns on investment in the fixed income market. It will help possibly to stimulate a lot more savings because of the increase in the returns in money markets. But the flip side is that it's going to hurt a lot of investors, particularly investors that are already exposed to the banks in terms of credit over the long term. Their cost of credit will increase. And we all know what challenges many of them are facing at the moment. Challenges around FX scarcity, FX depreciation, challenges around the high energy costs, challenges around the high cost of logistics. So this is going to compound the problem of these investors. Of course, I take the point that the CBN has talked about being more aggressive in the area of development finance. But how many investors have access to the development finance window? So it's going to hurt quite a lot of investors. Let me say that because of the nature of this economy, I would say that even the financial system is already very tight. Because CRR of 27.5% already is a very tight monetary regime. In many other jurisdictions, the maximum you have of CRR is about 10%. And I also see a kind of bandwagon effect in this move. Of course, the Bank of England, the Federal Reserve Bank, the European Bank, South Africa, all of them are moving interest rates. So we need to relate to our own peculiarities.
Yeah, but Dr. Yusuf, I mean, even the central bank governor said it yesterday that, I mean, so it doesn't look like the central bank is not carrying out its core responsibility, which is to deal with inflation. And now they've moved the rates, and people are still saying that it's a bandwagon decision.
No, of course. I mean, we have to look at the peculiarities of our environment. If you talk to operators in the banking system, some of them have CRR that is up to 50% already. Some of them even more than that, effective CRR. And of course, when you look at our situation, the inflation we are dealing with are essentially driven by the supply side factors. Factors around currency depreciation and impact on costs, factors around scarcity of foreign exchange, around insecurity, around cost of energy, around the cost of transportation. And on top of that, the CBN financing of fiscal deficit is also a major factor. These are much more fundamental factors. And I can tell you, this movement of MPR is not likely to have any significant effect on inflation. You can take note of that. It's not likely to have any significant effect
Okay,
we need to deal a lot with the fundamentals.
About growth? What about growth? Because some economists and analysts have expressed fear that it will stunt growth and it will also have negative impacts on employment.
It will affect investments, definitely, because if you're an investor and you have to borrow at a much higher cost, in addition to all the other variables that you are dealing with in the environment, it will affect investment. It will affect even the stock market, because the stock market essentially drives investment and growth. But this is now going to have a negative effect on the stock market. We are beginning to see that already. A lot of funds will now begin to move from the stock market into the money market. So there are pros and cons, there are costs and benefits.
Yesterday, Dr. Yusuf, equities market was down almost 2%. Although we have not connected it, but I mean...
No, that is just the beginning. It will have that because the 150 basis points is quite significant, and it's going to affect our performance in the stock market. What you saw yesterday was just the beginning. That is the trend that we'll see for some time to come. So, what is the nature of monetary economic policies? There are costs and there are benefits. But in this instance, I think the cost will be much more than the benefits.
All right, Dr. Yusuf, just before we let you go, another thing that came out from that meeting was the CBN is going to hold lending rates at 5% till March 2023. What's the implication of that?
Well, the 5% is for those who are in the development finance window. That is the CBN intervention funds. That, for me, I think is a very good thing. At least those segments of borrowers will not be exposed or will not be impacted by this movement in the MPR. So for that, I think it is good for those who are beneficiaries of that window. But what proportion of the private sector are in that window? That is the issue. So the larger components of the private sector are going to take a big hit. And I can tell you from today, many of the banks will be writing to their customers that are indebted to them to review their interest rates.
Wow.
So that is an added burden to whatever businesses are already facing. And the times are really hard. So that is the worry that I have. And this economy is not a credit-driven economy.
All right, I think...
There is strong correlation.
Okay. All right, Dr. Yusuf, just in a minute, less than a minute, is there a way to balance this attempt to quell inflation and also still allow at least the fragile growth and recovery that we see in the economy? Is there a way to balance both of them?
Well, the way to balance both of them is to get the fiscal side to do a lot more to address the structural issues, insecurity issues, to create a lot more environment for us to see an improvement in productivity and output. Because we are practically reached the limit of monetary policy. That is the point. So if you have a lot more action on the fiscal side, dealing with issues of the investment environment to increase output and increase productivity, I think that will bring some balance to the situation.
All right. Thank you so much, Dr. Muda Yusuf, the Chief Executive Officer of CPPE. Thank you so much for sharing your thoughts with us this morning.
Thank you very much. My pleasure.
The program continues in just a minute, and then we will move to the e-commerce space. The government has been talking about taxing the digital economy and also, of course, inculcating more digital instruments and technology in the collection of taxes. Well, we want to find out how far they've gone. We'll do that after the break. This is Business Morning on Channels Television.